how the pandemic affected working capital performance in 2020. Topic of my conversation today with Craig Bailey. He is Associate Principal for Strategy and Business Transformation with the Hackett Group. Hello, Craig.
Hi, Rob. How are you doing today?
Well, and thank you for being with me. So what was the impact of the pandemic on working capital according to this survey, and why?
Well, what we saw, Rob, with the pandemic was that liquidity was really very much top of mind last year. And we saw that companies were holding cash. They were borrowing at record levels. We saw debt was up, cash on hand was up, and overall working capital performance did deteriorate across the 1,000 companies, 50 industries in the Hackett study.
Mhm.
That was partly influenced by the oil price. And when we correct for that, we saw a slight improvement in working capital performance when we look at the cash conversion cycle. But this was driven purely by accounts payable.
Yeah.
Inventories and receivables both deteriorated during the pandemic.
I believe we had seen a trend even prior to the pandemic of buyers slow paying suppliers with even longer payment terms. And so this sounds like it's even an extension of that. I just wonder it gets to the point where the supplier's own stability comes into question if they don't have access to that capital and they're getting slow paid so poor. I mean, it must have been a struggle for them.
We did see elements of that last year. One of the differences in the pandemic was whereas previously we'd seen structured payment terms extensions, during the pandemic, some industries were slowing payments, withholding payments.
Mhm.
Others were pushing payment terms extensions out onto their suppliers. But at the same time, we did see some organizations who were actually helping their suppliers. They were looking to see where they should reduce terms in the short term.
Oh, well, that's interesting. It's awfully nice of them. But I guess the realization is they need the suppliers more than they might have thought. Supply chain finance options were also popping up a lot before the pandemic, the attempt of buying this debt and finding creative ways to get those suppliers paid in a reasonable time without the buyer having to, having to worry about spending that money too early. Was that also in evidence during the pandemic?
What we saw during the pandemic was more short-term measures.
Mhm.
What we're seeing now, as we're going back to normal, we're seeing more organizations looking again at supply chain finance solutions. But what we're also seeing is some uncertainty at the moment that you referenced there. Some uncertainty as to how much further the payment terms can be pushed, how many suppliers are going to embrace supply chain finance programs. And also, one thing that the pandemic has shown has been the risk of concentrated supply. And we're expecting to see that risk being factored a lot more into those payment term strategies going forwards.
Does that translate into a diversification of supplier bases so that the individual suppliers that were getting all that business are going to get less of it because the buyer wants to spread their business around to mitigate risk?
Potentially that could happen depending on the industry. And we've certainly spoken with some companies who are considering diversifying supply. Obviously, if we do that, then we have the risk of reducing our leverage, which can impact our ability to negotiate extended payment terms.
Yeah. Now, this study I focused, I understand, on 2020, right? Last year,
That's
right?
right. Yep, 2020.
Have you seen any later research that indicates what's happening now in the first half of 2021? Are we seeing, you suggested that perhaps some buyers are stepping forward to ease those terms a little bit. Is the situation getting better from a supplier standpoint?
We haven't seen any indication of that yet. We reran the figures at the end of Q1, and we saw there a continuation of the same trends of 2020,
Hmm.
which didn't surprise us because we're still seeing and hearing so much uncertainty out there in the market as to when we will get back to normal, but also what will future demand patterns look like and what will the future supply landscape look like as well.
Well, to what extent are these slower payment terms and the lack of access to this capital causing suppliers to find difficulties in meeting this growing demand for product? We've seen a surge of demand for consumer goods lately, and yet these suppliers may or may not have the money in order to gear up to meet that. Is that a problem?
It's not a problem that we have come across at this point. As I said, we did see evidence of organizations who were assessing the health of their supply base and making sure they weren't pushing the terms too far. And in many cases where those terms did extend last year, it was really because the customers themselves were pushing the supply base for help, particularly when we look at those industries which had substantial decrease in consumer demand last year.
Yeah. Another thing I wonder is, we've been hearing for years to the extent to which buyers are really calling the shots with suppliers in terms of when they pay them, how much they pay them, and the things like that. I have been hearing more and more that at least temporarily this year, the balance of power is shifting back to suppliers because buyers need them so much to fill customer orders. Is that in fact the case? And are suppliers enjoying kind of an unusual sense of power that they may not have before, or may not have going forward?
Well, there's certainly some shortages out there in the market that we all see in the media, and that certainly is helping the suppliers in those negotiations. What will be interesting will be to see how that continues in the future, how those shortages continue, and whether that balance of power shifts back again to the customer.
Yeah. You alluded to the increase in corporate debt. Is that on the part of both buyers and suppliers generally, or where do you see that most happening?
We were seeing that across the board
Mhm.
in vast majority of the 50 industries that were part of our study. We saw that the debt had increased and the cash on hand had increased. We saw organizations drawing down on revolvers and really, again, just preparing themselves for rough times ahead and that uncertainty.
What about inventory levels? What's happening with them right now?
Well, inventory levels really have been very industry specific. What we did see going into the pandemic was a lot of organizations holding excess inventories. During the pandemic, obviously, we saw a lot of consumer demand was directed and channeled into very few categories. And those industries, we're talking here food and staples retail, recreational products, they really saw inventories coming down. Most significantly was in the internet and catalog retail. That wasn't due to managed reductions, but really just the ability to keep up with the consumer demand. What we saw in other industries, those particularly that have been impacted by store closures and severe reduction in travel, we saw there that inventories as a whole were coming down, but they weren't keeping pace with revenue. So the days inventory metric was deteriorating. And
Mhm.
obviously, this is something that a lot of organizations are thinking about very carefully now in 2021. They're having to look very carefully at what will that future demand be and trying to manage those inventory levels. So that there's some that will be ramping up inventories, but others who had maybe a very good year last year who are now having to manage those inventories in terms of what will the future demand be? How much of that demand will I lose to other channels now that
Mhm.
the economy is opening back up again?
To the extent that companies are rethinking their just-in-time policies and certainly not rejecting them outright, I know, but to some extent we are hearing that companies are beginning to place more value in the notion of buffer stock or safety stock. That's going to put more demand on suppliers to produce as well. And suppliers still being slow paid, that seems like you're in for some kind of a collision there going forward. Is that a possibility?
Well, what we could see there is increased ordering on suppliers. We're
Mhm.
seeing that even at the moment in the grocery and food retail space, where retailers are stocking up on inventories in anticipation of price rises. So certainly there could be a short-term demand increase on certain suppliers. What we're also seeing, which has been very interesting, has obviously been that real shift of consumer demand to the e-commerce channel last year. And that is going to be very interesting to watch going forwards in terms of to what extent will consumers be going back to traditional shopping and consumption methods, or has the pandemic actually educated individuals that there can sometimes be a lead time between ordering a product and receiving it.
Mhm.
And that could open up some very interesting opportunities for organizations in the future if they were to continue to go down the e-commerce route, which would obviously lead to a very different stock holding and network strategy, or will they go back to the traditional bricks and mortar retail route?
Which of those actually places more of a demand on working capital, if it can be said that one does?
In many ways, the traditional bricks and mortar retail environment can put more demand on working capital just from the nature of requiring much higher inventory levels when we look at the inventories within each store. Also, when we look at the e-commerce, if we are going direct to consumer, we see a very different perspective there on the accounts receivable. where consumers are generally prepaying and won't have payment terms, whereas a third-party reseller would have those payment terms. So those together, both on the accounts receivable and the inventories, could lead to a transformation of the working capital strategy for organizations who decide to go down that route.
We've seen some price rises lately and some inflation beginning to rear its head for the first time in a long time. How long and how big that will be is anyone's guess. But is there a direct relationship between interest rates and inflation and these factors that we've been talking about here with regard to supplier health, working capital, inventory levels? Does inflation or do interest rates have a direct impact on that? And how might they do in the coming year?
Most certainly, and what we'll expect to see there is a renewed focus on working capital.
Mm-hmm.
In the past, when those interest rates have been low, it's often been difficult for a CFO who's been really trying to optimize working capital to get the buy-in of the cross-functional operational team. Whenever we're looking at working capital, we're balancing cash with cost, also with service and material availability. Now, as interest rates go up, that cash will become more important to the business. That could then change perspectives in terms of how organizations should be prioritizing working capital and what that working capital strategy should be, particularly when we look at inventories. What we've seen over the past 5 years has been really a prioritized focus on accounts payable and accounts receivable, they're often perceived to be the easier areas to go after. When we're looking at inventory optimization, it's very much an internal conversation within an organization where we have competing stakeholders. We may have the finance function looking at cash, the procurement function looking at cost. Mostly the commercial function will be looking at material availability and maximizing revenue. So when interest rates are low, it can be harder to really define a working capital strategy or emphasize working capital importance. As interest rates increase, then we should see a change in the approach there to inventory management.
I see. Craig Bailey, I want to thank you so much for sharing the recent insights of the Hackett Group into trends in working capital, inventories, corporate debt, all essential elements of the supplier, buyer, and supply chain relationship. Thank you very much for being with me today.
Thank you for your time.